America's kids are facing a new kind of risk, one you probably didn't see coming.
The Trump accounts, as they call it.
The federal government will seed with $1,000.
When you come into the world in the U.S., you get a Social Security number and a brokerage account.
A new policy in the One Big Beautiful Bill Act gives every newborn $1,000 in an investment account. These accounts have been called Trump accounts. Think of them as 401ks for babies. The money will grow passively until the kid turns 31. And if you know anything about compound growth, you're probably wishing you had one too. This video isn't about how these accounts work or if they're good or bad. Instead, we'll talk about the investing strategy behind them, something called passive investing, which is how most Americans build wealth these days, and why babies joining in could amplify hidden risks. Here's what you need to know. Before we get into how babies could affect passive funds, let's start with what passive investing even means.
It's basically a set it and forget it strategy. So instead of trying to time the market by picking certain stocks, you just put your money into an index tracking fund like the S&P 500 and then just hold on to it. No micromanaging.
That's Gordon Gottsagen, MarketWatch's retail investing reporter. I wanted to talk to him about some of the hidden risks that come with passive investing and why babies could make things worse. All right, Gordon. Let's say these jars are our investment accounts. I'm going to put $200 in this one every month, no matter what the market's doing.
And then I'm going to put money into these different stocks and try to time the market by buying low and selling high.
Now fast forward 10 years. Who comes out ahead?
Statistically, you do. Passive funds tend to beat active funds over long periods of time. And on top of that, active funds tend to charge higher management fees than passive funds do.
So it's cheaper, easier, and most people come out ahead?
Yes, and that's why passive investing has exploded over the past decade. Now it's roughly half of the ETF and mutual fund market.
By this point, passive investing seemed like a no-brainer. Why would anyone bother with active investing when passive funds yield better returns with less effort? And what could be the harm in babies joining in? Well, it turns out passive investing comes with risks.
First, there's market concentration. While you think you may be investing in the entire stock market, the way these index funds work and are weighted means that you might end up actually only investing in just a few companies.
So you're not spreading out your money evenly?
Not exactly. You're putting more money into the larger market cap funds. So think about the big tech companies, the Apples, Microsoft, Nvidias. A lot of your investment goes towards those.
So it's like a self-perpetuating cycle. The more money that goes into these funds, the more a handful of companies grow. The more they grow, the more they dominate the market, and then the more they're weighted in the index.
Exactly. So that means if one of the big tech companies stumbles, your entire portfolio will take a hit. Which brings me to the second risk, which is volatility. If we remember back in January, when the DeepSeek revelations brought Nvidia much lower, Nvidia wasn't the only company affected. The entire NASDAQ was brought down with it because it's so weighted in that index.
Let's pause for a sec to digest what Gordon just said. Nvidia makes up about 10% of the NASDAQ Composite Index. And if 10% doesn't sound like much, keep in mind that there are more than 3,000 companies in this index, with a much smaller weighting. So compared to Nvidia, most companies are like bumblebees, buzzing around the Empire State Building. This is why when a big company like Nvidia falls, it takes the rest of the index down with it.
And these indexes also rebalance, which means that they drop some companies and add new ones, which can have an effect on these stocks that get added or subtracted.
Can you walk me through how that works?
Sure. So when an index rebalances and removes a stock, that means all the funds that track that index have to sell that stock immediately in order to stay up to date.
That could probably tank the price of that stock.
Yeah, but the opposite is also true. So if a stock gets added to an index, that means all these funds are buying at the same time, which could create an artificial pop.
By now, I'm starting to get the point. About 3.6 million babies are born in the US every year. And if all of them opened Trump accounts, it would mean billions of extra dollars flowing into these passive funds And as Gordon explained, the more people who invest in passive funds, the more concentrated and volatile the stock market becomes.
That's not to say passive investing is a bad thing. It's actually really helped expand market access to new investors. It's just not perfect. It's not a silver bullet. The very things that make passive investing appealing can also make markets fragile.
And now bring babies into the mix? Can the strategy hold if everyone's doing it?
We'd have to wait for those babies to grow up to see what happens.